Hello and Happy New Year. You're watching the first episode of Market Week in Review for 2015 for the week ending January 9th. I'm Alexandra Davis, coming to you from Russell Investments Global Headquarters here in Seattle, Washington, and I'm joined today by Chief Investment Strategist Erik Ristuben. Welcome, Erik.
Morning, Alex.
Good to see you. So certainly kind of a wild market swings this week to start off the new year, as we saw the global markets really rally at the end of the week, but then we've seen them reacting to positive U.S. jobs number this morning.
Reacting negatively.
Yep.
Which is interesting because it was a good number,
yeah.
right? We saw actually go back a little bit in the week. The FOMC came out with their meeting notes from the last meeting and really confirmed what everybody's thinking they're thinking, which is they see progress in the U.S. economy. There was a discussion, a fairly robust discussion, it sounds like, around would international weakness, weakness outside the United States actually begin to significantly affect the strength that we're seeing in the U.S. economy. And it seemed to be that the broad consensus was no. Now, they then also kind of reconfirmed that they're on track to probably raise rates in June, mid-year, let's call it June. So all of those things were kind of positive for the economy. The jobs number comes out, it's 252,000 jobs. That means the year, 246,000 jobs a month were created each month in the United States throughout the course of the year. That's the best job creation year we've had since 1999. Wow. Jobs did really well. But in that report, as you mentioned, were wages. Hourly wages actually ticked down a little bit. And so folks better get used to hearing a lot about wages, because this year is around, guys like me are looking at wages, particularly the hourly wages, because we want to see if there's upward pressure. Because what happens is, with unemployment now at 5.6%, at some point, employers are going to have to start bidding up for employees because there's few potential new employees out there because the unemployment rate is low. And when they start doing that, you see wage pressure start moving up. That's a sign of inflationary pressure. That's a sign that the Fed may come in. So get used to hearing a lot about wages throughout the course of 2015, particularly in the United States.
Okay, now another factor this week was oil. Now, while lower oil prices certainly had somewhat of a positive impact on the global economic outlook, do you see any significant geopolitical and market risks from the price correction?
Well, yeah, I mean, we're probably in this frame where, oil now is at 48 and change on WTI. So West Texas crude is trading under $50, and it's gone precipitously down. Now, that, as you said, we view on balance as being good, particularly for the developed world, particularly for the non-oil exporting, oil producing developed world. And so, in general, we think it's good for the United States. In general, we think it's good for Europe, Japan. You kind of get the drift. Now, where it is not going to be so good is obviously in oil-producing nations, and in particular, oil-producing nations that are probably in the emerging market category. Because what you're talking about is, for all those countries, it is the number one revenue source, oil. And now you have, it's half price. And there's going to be budgetary pressure, and there's going to be fiscal pressure, and a lot of times that leads to political pressure. So yeah, that's a watch point for us all year round. It may be, if oil stays at this level for an extended period of time, it's probably not a matter of if a country, but rather what country. So Venezuela will be under tremendous pressure, already are. Russia, a whole series, Nigeria, a whole series of countries that you want to keep your eye on to see if there's political upheaval in those countries.
Okay, now central banks are certainly a theme for 2015 as well, and you mentioned the comments from the Fed this week. Also, we heard some comments from the European Central Bank. Talk about what those mean for investors.
Yeah, the Fed stuff is much less interesting than the ECB stuff. So the ECB, again, what you saw this week, the news item out of Europe was that if inflation on the CPI was down minus 0.2 on an annualized basis. So you're talking about, prices have actually dropped, to negative territory in terms of the growth of those prices. Now, the vast majority of the reason is oil. That's main reason it's ticked down. But it reconfirms, we've been talking about for 3 years now, Draghi's number one concern is the lack of inflation. Number two concern is lack of credit creation, but inflation being a major issue for him. He has gotten himself to the point where, through all his talk and all his prior maneuvering, the market is really expecting the ECB to do something extended in terms of providing liquidity and even additional stimulus to the marketplace. So people are thinking about QE. Sounds like they're kicking around doing that at investment grade. I think the market is now expecting to see be some form of sovereign QE. There's some legality issues they need to work through, but the bar is pretty high for the ECB on the 22nd of this month, so it'll be very interesting as we get into next week, the week prior to that meeting, what we see in terms of the messaging out of the ECB. But I think they're in a position where they're going to have to do something on the 22nd, and I think it will probably be reasonably large.
Okay, well, we'll check back with you next week. Thank you for your insights as always, Erik, and thank you for watching. We'll see you next time.